You'll notice, those of you who are students in the audience, that us financial market practitioners take a rather different approach to the academics. We don't spend much time looking at theories, assumptions, or models. We just look at what the real world is telling us and about what has happened and about what is therefore likely to happen. And that requires evidence, evidentiary support. I wouldn't go so far as to say empirical evidence, but certainly evidentiary support for every point we make. Rather than just saying it, we show it. So first thing, what caused the inflation? The blue line shows you the normal way that in the UK economy, we increase money supply, which is the increase in bank lending. And you can see that the increase in bank lending, although it stayed positive, has been on a downward trajectory, certainly since COVID started. But the big increase in money supply, which is the red line, the difference between those two is QE. So that was what the Bank of England contributed. I heard some of the academics speaking earlier, talking in a way as if the central bankers could be forgiven for not predicting inflation, as if it was some sort of exogenous shock. It's not exogenous, it's endogenous, and it shouldn't have been a shock because they did it. So if we, and you can see that QE is what made the massive difference in money supply growth compared to underlying commercial bank loan growth. So another point to make here is that although they rather farcically and desperately tried to blame inflation, which initially wasn't transitory, and then it just started accelerating, and this isn't just in the UK, it's any country that pursued this money printing exercise during COVID. And then they tried to blame it on Putin and the distortion of gas prices in the Ukraine, which wouldn't apply to the US anyway. So therefore, that was always nonsense. But just to emphasize the fact it's nonsense, by the time Putin ordered his tanks to roll, UK RPI was already up 8.2% and HCPI up 6.2%. So it's quite clear that none of the reasons that they've given, all of which are designed to avoid the blame resting where it should, which is squarely at the Bank of England's door, none of these reasons were valid reasons for what caused the cost of living crisis. It was entirely irresponsible, cat-handed monetary management by the Bank of England. And if you're talking about the US, by the Fed, and if you're talking about Europe, by the ECB. So if you have a look at another speaker earlier today also brought up the fact, in fact, it was the same speaker, that QE hadn't created inflation in the past, so why should it create inflation in the future or during COVID? This is lazy work in the extreme. The reason why QE didn't create inflation during the great financial crisis aftermath was because of the counterfactual. So here I've got UK broad money supply growth in blue, excluding those machinations by the central bank, and the red line shows actual money supply growth. So the big gaps between the blue line, what was happening at the banking level, and the red line, what was happening net to overall money supply growth, those big gaps are caused by QE. Now, why did we not have inflation following the great financial crisis? Well, because if we hadn't have had QE, in the counterfactual, or in the absence of QE, we would have been looking at something akin to, maybe not as serious as the 1930s Great Depression, but something akin to that, i.e. a genuine contraction of nominal broad money supply growth, which is the old-fashioned definition of deflation. So if you do QE, it really matters what the backdrop is, which brings us fast forward to the COVID environment where they did QE, but there was no collapse in bank lending. There was no financial crisis, and therefore, this time it led to a massive increase in money supply. Now, the Bank of England had published in late 2021 its version of the output gap. We've had lots of discussions about the output gap, but the one thing you really need to remember about the output gap is that it is completely unobservable. Therefore, it's the last refuge of a charlatan. You have no idea what it is, you've no idea where it's going, you've no idea what it's going to do, and therefore it's fairly hopeless. But what the Bank of England did think is that the output gap, having taken an initial shock because of the COVID lockdowns, would bounce back to around about, by the end of, say, 2021 or beginning of 2022, would bounce back to where it had been just before COVID struck. Now, if that is the case, where did they think all the excess money they printed was going to go? If we go to the next chart, we can see that the assumption was, and this is very embedded in Keynesian theory, that what they call exogenous money, i.e. money created by the central bank, or the monetary authorities anyway, doesn't find its way into the real economy. It's basically akin to assuming that the precautionary balances that the household sector is holding during a downtime will be permanent. But that doesn't make any sense, because if they're precautionary balances, then once times come back to normal, then the demand for money balances will fall away. People won't need so much for a rainy day, and therefore the velocity of money will rebound. In fact, you can see here for the UK that the velocity of money has been rebounding quite strongly since the first quarter of 2020. And the excellent paper that Juan presented, which I'm going to pursue him for afterwards, 100 years of US velocity. That's going to be a fantastic chart to add to my collection. But the main point about velocity is that what velocity does is it remains relatively stable within a downward trend. That trend runs at around about 1 to 2% a year, just as Milton Friedman suggested. In the UK, it's about 2, in the US, it's about 1. But the point is that it's fairly stable within that trend. And if you are at the bottom of the trend, you're likely to bounce back up. And Juan's come up with a very compelling argument that this is positively correlated to a boom. And if you're at the top end of the range and you go into a recession, then you're likely to go down to the bottom. And the really important thing about this is if you printed a huge amount of money, so the Bank of England printed 22% additional stock of money, even though their own version of the output gap suggested the economy would be flat by 2022 compared to end of 2019, then they absolutely required that the velocity of money would collapse and stay collapsed, because otherwise we were going to find that the only way, as John Groomer was saying with his Jaws chart, which I think he might have stolen off me, is that the only way you can redress these balances is that if the velocity of money does trend revert, then you're going to have to hike nominal GDP. And since no one ever suggested, not even the Keynesians suggested, that printing money leads to real economic growth, then most of that effect is going to have to come through the N part of nominal GDP, i.e. the nominal part, i.e. through inflation. So if you have a look at, this is the same story, but sort of seen from a sort of slightly different perspective, you can see now why QE didn't create inflation back in the 2008 to 2012 post-financial crisis period, because although it prevented money supply dropping to the extent that nominal gross domestic product would suggest, which is the red line, you can see from the blue arrow that money supply growth was far slower than it had been pre the great financial crisis. And after the crisis was over, it started to accelerate again. But this time we had a completely different impact from the money printing, because this time we had no big counterfactual deflationary pressure coming from the commercial banks and coming from the non-performing loans. 25% of loans didn't perform in the US following the great financial crisis, and something worse than that in the UK as far as business loans, but not as bad as that as far as mortgage loans, because of course all our mortgages are set to short-term interest rates. But you can see by the angles of the arrows that there's a huge difference between QE after COVID and QE after the great financial crisis in terms of the net impact on money supply. And it is this very basic but absolutely crucial difference that has caused inflation this time when it didn't last time, and that the central bankers, with all their wizardry, there are 400 economics PhDs working at the Fed and another 200 at the regional Federal Reserve banks, yet none of these PhDs, mired as they are in the sort of the academic navel gazing that they seem to pursue in universities, most universities these days, seem to spot that this was the inherent problem and that it would be inflationary. So then we have this this problem, which is that we always knew, we should have known, we had a disaster waiting to happen, because the relationship over time between the level of inflation and the level of interest rates had become distorted after the great financial crisis. What had happened was that policy rates had been too low for way too long. This is financial repression, compared to the level of prices, which is the pale grey line. And so too had bond markets. And I'll have a look at bond yields in a second to talk through why that was because but it means that we already had this big gap between what mortgage rates, base rates, and short-term gilt yields were compared to their historical relationship with inflation. Absolutely the worst time to then let inflation loose and to bounce out of the bag. And now you can see how incredibly far behind the curve policymakers and bond markets have become by the arrival of this inflation, which they should have seen coming, but for all the shortcomings in their academic theories, didn't. Now, UK householders largely did see this problem coming. We not only had a long period of suppressed mortgage rates after the great financial crisis. You look at the bottom chart here. This is mortgage equity withdrawal. So this is where people take money out of their houses and sort of increase the size of their mortgage. And you can see that after the great financial crisis, even though interest rates were super low and therefore it was very financially attractive to do that, they said, no, I don't like the look of this. This whole thing looks bad to me. I'm going to pay down my mortgage even faster. This is another interesting illustration of why monetary policy, if pursued only through rates, can go horribly wrong. Why would people borrow less? Why would people repay their mortgages when you lower interest rates to a super low level? Well, because the average householder is not a dummy, and certainly did a far better understanding of what was going on than the Bank of England. If you look at the top chart, you'll see the yellow line. This is mortgages fixed at 5 years or above. You can ignore the above. Basically, in the UK, pretty much 5 years is the top end. But you can see that over this period that people were paying down their mortgages, other borrowers were extending the duration of their mortgage fixed period to 5 years. And now we have more than half of all mortgages in the UK are fixed for at least 5 years. UK homeowners knew this disaster was coming and they prepared for it. So again, even more non-kudos on the Bank of England. Why didn't they see what the average householder did see? So now we have a genuine recession risk. We've got a massive increase. Historically speaking, it's been about 2 to 3% of household disposable income has been what we have in the Western world have got used to spending on our gas and electricity, particularly electricity. And if you look at the right-hand chart, without the caps, that was suddenly looking like it was going to possibly even treble, but certainly double. And this is what we're having with the cap. So with the fact that the cap will be removed next April, or at least that's the new plan, it keeps changing, that suggests that the UK is looking at a very stiff recessionary headwind coming from this. Now, this isn't inflation. It'll be reported as inflation. It'll appear to be inflation in terms of its impact on CPI, as will, in fact, the rise in mortgage payments. But these are not inflationary. These are actually shifts in the terms of trade and will have to be compensated for elsewhere. The left-hand chart shows that, again, just the change that has occurred within the mortgage market away from floating rate notes. So floating mortgage rates, that's the blue part of that chart, that's actually now relatively small. It's less than 20% of the total mortgage market. But don't forget, people who pay rent or paying rent to landlords who themselves might be on floating or fairly short fixed term mortgage rates. So we're going to get an impact feeding through to all sorts of people in the near term in terms of higher rents and higher mortgage costs to combine with these higher utility bills, all of which looks like a very recessionary impact to come, and all thanks to the Bank of England's extraordinarily irresponsible handling of the whole COVID affair. So if you have a look at the financial markets, what happened? You will have heard about the LDI, which is the liability-driven investment problem for the pension funds with bonds. So for a long, long time, pre the great financial crisis, which is that vertical line there, we could see in the UK, and it's exactly the same for Europe and the US, that there was a relationship between 10-year gilt yields. I'm using 10-year here because that's the benchmark. That's the blue line. There's a strong relationship between that and the historic 10-year average of inflation. Here it's RPI plus 200 basis points. And you can see that post the great financial crisis, this massive gap opened up between the level of inflation. This is the 10-year average, which is why the red line doesn't show the big spike. It'll take time for that to feed through into the 10-year average. But you can see a massive gap had opened up between these very super low bond yields, or gilt yields in the case of the UK, and the level of inflation. This was the disaster waiting to happen when this gap closed. And in fact, this is what we've just had in this big shock in the financial markets, which is yet to finish its repercussions, is the closing of this gap. So what has happened over the period of the mini budget was not an event. It was the end of an aberration that had gone on for the prior decade. So if you look at 10-year gilts, now in actual fact, 10-year gilts have now bounced back up and the US Treasury have sold off a bit. So the gap between the blue and the red lines has now fully closed. So in actual fact, although Kwasi Kwarteng got blamed for what happened on the mini budget, it was really just a bad luck, coincident timing, and short-sighted blindness by the press and the Conservative MPs who hadn't noticed that this had been going on for 2 years, albeit at an ever-accelerating rate. And the amount that UK gilts have sold off is no different to the amount that US Treasuries, for example, have sold off over the last, over the post-COVID period. And it's all happening for the same reason. Gilt or Treasury holders don't like inflation because they're only paid a small amount of non-inflation adjusted interest. And so the longer the inflation hangs around, the more nervous they get that they're just going to see the real value of their holdings eroded, and the more they feel compelled to sell them. So we got this from Sir John Cunliffe at the Bank of England to try and explain what was happening with LDI. But what's really interesting about it is that this explanation involved basically disingenuous under-mentioning of a whole host of things that make this scenario worse than it looks. Firstly, gilts make up the vast majority of the assets that pension funds hold. He'd written here on his diagram, other assets on the left-hand side. Well, those other assets are gilts. He made it seem that they only had some gilts which they bought on a leverage basis, but they mainly had gilts in the other assets portion as well. In fact, gilts make up the majority of all the assets held by UK pension funds. The gilts that they hold almost exactly equal the LDI strategies. So basically the LDI strategies have almost entirely, the gilts have been used as collateral to borrow and get the 2 times leverage to basically double up their exposure to gilts. But 20-year gilts, which is the main index-linked 20-year gilts, is the main holding of defined pension funds on their portfolios. These are basically halved since the end of 2020. Now, Sir John Cunliffe's chart on the right-hand side shows that the overall funding ratio has improved. Well, yes, there is a very extraordinary way that the actuaries value things. So if the value of your shares drops by 20%, then you're 20% underfunded. But according to the actuaries, if the value of your gilts falls by 20%, then you're overfunded, because now it means that the gilts give you a higher yield. Well, they don't. That's preposterous. What it means is that if you started buying gilts today at the new cheap price, they would give you a higher yield. But none of these funds did do that. They all bought them at the at the high price, low yield, prior to the sell-off. So the idea that you've got an improvement in your funding ratio is just smoke and mirrors. And basically it means that, you know, we have a much worse situation here for pension funds than anyone seems to have noticed. I've seen a lot of press coverage saying, oh, it doesn't really matter, you can get a better annuity now with your fund. Well, maybe you can get a higher annuity rate with your fund, but you also have got something like only 75% of the fund you thought you had to buy it with. So this is still a problem that we have yet to deal with. Now, why do gilt yields and treasury yields, because I put treasury yields on here too, which are the red ones, these are the real government bond yields for the 10-year benchmark. And you can see that back in 1995, in the UK, the real yield on gilts was about 5%. And in the US, the real yield on treasuries is about 3.5%. And now you can see that in the last decade or so, the real yield on gilts had fallen from positive 5% to negative 1%. What made this happen? Well, what made this happen was regulatory changes, which forced effectively pension funds to move their holdings out of equities. Back in the 80s, pension funds were almost entirely invested in equities and put themselves almost entirely, that's a slight exaggeration, but almost entirely into bonds, because governments wanted pension funds to lend them money cheaply. The regulator thought it was easy. They thought that the 20-year liability of a pension fund would match the 20-year duration of a gilt, but somehow wouldn't match the unlimited duration of an equity. But anyway, they used farcical maths, and you'll remember that we had farcical, silly maths ideas that played a prominent role in the mortgage crises ahead of the great financial crisis. We had the same thing here in this country and in the US, but worse in this country, where they forced pension funds out of equities and into gilts, which means that gilt prices were pushed too high, gilt yields were pushed too low and kept there, and that's why we had a disaster basically waiting to happen. So is QE and what the central banks have been doing, is this a useful contribution to society? Is it helping the most important thing of all, productivity? Well, here is UK whole economy productivity with the dotted arrow showing us where it would have gone if we hadn't basically had the contribution from the central bankers. QE coming in, and actually there's 3 lumps of QE in there. Well, it's 4, because I'm forgetting the totally farcical Brexit QE as well. But what happens when you do financial repression? What happens when you push interest rates too low? What happens when you print money with QE is that all the correct signals to the economy in terms of economic activity go wrong. UK homeowners knew this and started paying down their mortgages and fixing for as long as they could, because they knew that disaster would happen. And the main disaster that happens is that you push the economy off the rails and you stop it pursuing what it should be pursuing. More big government. We now have taxes as a percentage of GDP, which are the highest since the Second World War. What do big government, high taxes, QE and very, very low interest rates, i.e. too much government intervention and financial repression, what do they do to the real economy? They completely starve it of oxygen and incentives. And that's why we've had this collapse in productivity, which they laughably refer to as the productivity conundrum. There's no conundrum here. You know, if any of this stuff worked, then communist Russia would have won the Cold War. So we know that this is bad, and therefore one of the good things that might happen is that we end up you know, going back into a better economic environment with better incentives. So this is no, back one. So this is the global value of the oil market, this blue line, and you can see that it's trades either side of the red line, which is the global value of GDP, and the oil market is not too far from the middle part of that range. Now, this is a major problem because since 2014, we've had a total collapse in exploration and production capital expenditure. So we have an extremely short supply in the oil market, and we're only just not seeing that in oil prices at the moment because China is still in zero COVID lockdown. When China comes out, we have an almost instantaneous oil crisis on our hands, no matter really what OPEC or Russia do. So that's another thing to bear in mind in terms of inflation, although really, to be technically correct, if we have an oil shock, that's actually a shift in the terms of trade. But what has historically happened is that governments, when they have a shift in the terms of trade, then relax all the control that they have on money supply and therefore accommodate the inflation. So again, if you go forward, so now you can see that after 30 years of wage growth of only 3% nominal, but you know, plus or minus 1 or 2% either side of that, we've now burst out of that, and from now on, wages are going to be a source of inflation as well. Next, so what you're looking at here, I heard some commentary earlier from some people who are still purporting to this farcical academic argument that that money supply growth doesn't seem to explain CPI. That's nonsense, and you can prove it, and they never do prove it when they say it, which is quite interesting. But here you have a pretty close relationship here between UK nominal GDP and broad money supply in red, and you can see that massive surge of money supply growth compared to nominal GDP, which I've ringed. That is what caused our inflation. And my last slide is to show how long the inflation now will probably last. So this is the same slide that John had in terms of jaws. So this is the money supply in blue compared to the nominal GDP in red, and we can see that this could close out as early as end 22. It depends a lot on the angle of trajectory of nominal GDP, but we are looking to close that out. So one of the options that the Bank of England would have is to not be raising rates too aggressively and to allow these jaws to close. I'm actually less bearish than John is in terms of what the inflationary implications of that would be. I think it would probably all be over by next summer or so if they did that. But they're not going to do that. They're going to pursue the wrong policy, look at interest rates, and then do QT. And QT, of course, will bring that blue line down. And if that blue line comes down and crosses the red line, then we go into a nasty recession, which is possibly likely if you look at oil prices, etc. as well. So that now is my finished article.